Good day to all. My name is 𝗪𝘆𝘀, iFAST Research Analyst. As we enter into 2024, we see a divergence in growth amongst developed markets. Notably, Europe takes center stage. In Europe and the UK, inflation remains a concern, with services inflation remaining sticky. At the same time, when there are signs that the region's economy is slowing down, making it most susceptible to a recession if economic conditions deteriorate. Our anticipation of interest rates remaining higher for longer further underscores the challenges faced by Europe. The swifter transmission of interest rates is a concern, magnified by a higher percentage of corporate borrowings at floating rates as compared to US. Adding to the complexity, China's ongoing economic challenges cast a ripple effect across the globe, denting cross-border trade and foreign direct investments with Europe. As these economic ties weaken over time, it could impede Europe's growth prospects. Beyond immediate hurdles, Europe grapples with longer-term structural issues, including a lack of energy self-sufficiency, lower productivity growth, and falling behind in terms of technological innovation. These structural challenges will need to be addressed for the region to enjoy sustained economic growth. With our revised fair PE ratio of 14 times, we project an upside potential of around 15.5 times for the stock 600 index by the end of 2025, and maintain our star rating for Europe at 2.5 stars neutral. To get the full analysis, scan the QR code or click on the link in the description below. Next up, 𝗍𝗰 will talk about retail bonds. Over to you, 𝗍𝗰.
Hi, I'm 𝗍𝗰, Research Analyst at Global Fixed Income. 2023 had been a great year for the Singapore T-bills, and that was no surprise. But now we find it is time to bring back the focus back to retail bonds with the equally attractive opportunities while being more accessible than corporate bonds. Retail bonds are available to mass retail investors in smaller lots of SGD 1000 as compared to SGD 250,000 required for wholesale corporate bonds. Retail bonds also boast of more liquidity since they are available on both exchange and over the counter. Before we talk about the three bonds, let us quickly run through the three issuers. Frasers Property might see lower profits in FY 2023, but we still see Frasers as a stable issuer. The lower profits were a result of valuation changes as well as higher interest costs. However, we see its recurring income becoming stronger over the years, providing a stable income for Frasers. Overall, Frasers appear more than capable of absorbing the impacts and expected to remain stable from here on. SIA celebrates yet another half-year record profits in first half of 2023, with net profits up by a whopping 55.5%. Strong performance was once again primarily due to the travel demand, which had been boosted by the full reopening in North Asia. SIA's credit profile continues to be resilient, with the large amount of cash mitigating any liquidity issues it might face, if any at all. Lastly, for the SGX portfolio, we saw a drop in net asset value across first half of 2023, but total portfolio continues to rise further. While unrealized mark-to-market losses was significant for first half of 2023, we remain optimistic given the reserves account already covers more than half of outstanding bonds. Meanwhile, management of the portfolio also remains highly optimized. Coming to the recommendations, unfortunately for the SIA SP 3.03%, we saw quite large downward adjustments in yields recently. Nonetheless, SIA looks great with the healthy credit profile and also ample liquidity. For FPL SP 4.49%, it is best recommended for the short to medium duration, which offers a good yield pickup against the likes of fixed deposits. Frasers should continue to look stable despite the volatility in the real estate space. SGX Class A1 bonds with a credit rating of A+ by S&P and Fitch. It may seem complex, but the options are what makes it attractive for investors. We expect it to be mandatory callback in 2026 given the progress of the reserves accounts, while the bonus redemption amount will sweeten the deal further. This will be ideal for investors looking for the assurance of a good credit rating. To get a full analysis, scan the QR code or click on the link in the description below. That wraps up for the sharing of this week. Stay tuned for more investment ideas and updates.